Hi, this is Lara at Elliott Wave Gold with a new weekly format for you with a once a week, end of week analysis of gold, S&P 500 and US oil. Starting off with gold, and then I'll look at the S&P 500 and then I'll look at US oil. The main wave count still expects we've had a trend change, we've got downward movement and it should increase in momentum next week. I've got two alternates at the weekly chart level. One of them expects that this last few days of downward sideways movement is just a correction within an ongoing upward trend, and that is favoured at the end of the week by classic technical analysis. And the other wave count expects a bit more downward movement before a final upward breakout from this huge range that gold's been trading in now for nearly 2 years. Elliott Wave analysis first, classic analysis last. This is the main Elliott Wave count because it has the best fit in terms of subdivisions, it has no problems in that it has no rare structures, and it follows the most common pattern within this triangle. It has the highest probability in terms of Elliott Wave, but it's come to the point now where it's making a rather large prediction. It's expecting we've had a huge trend change at cycle degree here, and that gold is going to start on a new bear market to last 1 to several years. The target for cycle C is calculated to assume the most common Fibonacci ratio may be exhibited to cycle wave A at 470. This main wave count sees a regular contracting triangle now complete for a B wave at cycle degree. A, B, C, D, E. E falling short of the AC trend line, and the multiple zigzag being primary wave C, that's the most common triangle subwave to be a multiple. This wave count fits all Elliott Wave rules and meets the guidelines for how a triangle most commonly unfolds, and regular contracting triangles are the most common type of Elliott Wave triangle. It's expecting that E is now over and we should be seeing an increase in downward momentum next week. But if E does continue any higher, it may not move beyond the end of C above 1357.09. Any new amount by any amount at any time frame above this invalidation point will fully invalidate this wave count at the weekly chart level. For this wave count, the invalidation point at this stage is now black and white. Let's take a look at how E may have ended at the daily chart, where E, this high up here, is this point here. E waves of triangles can sometimes be the quickest of all triangle subwaves. Here's a really good example. When this E wave ended, it was a little bit more quick than we had expected, and so let's not be surprised again. It is entirely possible that primary E could be over here, falling somewhat short of the AC trend line, and that's the most common point for an E wave of a triangle to end. From this low to this high, this upward movement looks and subdivides best as a three-wave zigzag at the daily and hourly chart level. This upward movement here, when you draw a trend line around it on the hourly chart, is breached by this movement here. So this is one wave, and this is the next wave at the same degree. That's the best way to look at this movement. And now we've got wave C, which has a Fibonacci ratio to wave A. And now, if you draw a trend line around this, a channel around this upward movement, or indeed all of this upward movement, it's breached by downward movement at the end of last week, telling us that this wave is most likely over and the next wave should be underway, which for this wave count should be the start of a new wave down at cycle degree. Cycle degree waves should last 1 to several years. At this stage, I'm a little bit tentative about the possible trend change. The classic analysis tells us that this movement here is also possible to be a correction within an ongoing upward trend. At the daily and weekly chart level, if we see a new low below 1236.54, that would add a lot of confidence to a trend change at cycle degree. And because this new wave down is expected to last 1 to several years, in terms of the target, that confidence point isn't too far away from where we are now, given the bigger picture. At the weekly chart level, this is a very bullish alternate. It sees cycle wave A in the same way, a 5-wave structure downward, and remember I've also got that alternate at the monthly chart level. If cycle A is over here and cycle B is beginning, if it's not a triangle, what other structure could it be? It could be a zigzag subdividing 5, 3, 5. So wave C has to be a 5-wave structure. There are only 2 structural possibilities, either an ending diagonal or an impulse. From this low to this high, it's possible, but it would look absolutely wrong if you tried to see this movement here as a 5-wave structure. And so because it's not a 5, primary C is indicated as a diagonal and not an impulse, because if it was an impulse, then its first wave has to be a 5, but if it's a diagonal, the first wave must be a zigzag. Within an ending diagonal, all of the subwaves, 1, 2, 3, 4 and 5, must all subdivide as zigzags. And so from this low to this high, it's entirely possible to see this wave up here as a zigzag. Primary C could be an ending diagonal, with a zigzag for 1, a zigzag for 2, a zigzag for 3 still unfolding, and then a zigzag for 4, which must overlap back into wave 1 price territory, but can't move beyond the end of 2, and finally a zigzag up for 5 to most likely end when it overshoots the 1-3 trend line. Within the zigzag of intermediate wave 3, minor wave B may now be underway, and it can't move beyond the start of minor A below 1236.54. That invalidation point is black and white, and that's why a new low by any amount at any time frame would invalidate this wave count at the weekly chart level and offer so much confidence to that main wave count. That's an important price point. Intermediate 3 must subdivide as a zigzag because it's a 3rd wave within an ending diagonal. At any stage, if we get a new high reasonably above 1357.09, then we can have quite a lot of confidence in this 2nd wave count. Let's take a look at the 3rd wave count now, where the low for cycle A is this point down here. And now what if cycle wave B isn't a single zigzag, it could also be a double zigzag. From this low to this high, this has a better fit. That 2nd wave count is a bit problematic, and trying to see this as a 5-wave movement, it has a better fit and a better look as a 3-wave zigzag. We're still seeing this as a zigzag, and now from this low to this high, we can see this upward movement as a double zigzag, and this also has a better fit. And so it's possible that cycle B is a double zigzag. The first zigzag in the double is labelled primary wave W. The double is joined by a 3 or a corrective structure in the opposite direction labelled X, and here X is seen as a possible regular contracting triangle, with a zigzag for A, a double zigzag for B, a zigzag for C, a remarkably quick zigzag for D, and now we need some downward movement to see a zigzag for E complete to most likely fall short of the AC trend line. E of a contracting triangle may not move beyond the end of C, not even a tiny amount. Any new low below 1236.54 by any amount at any time frame would fully invalidate this wave count at the weekly chart level, and again that's why a new low below that point at the weekly chart level would give so much confidence to the main wave count. This triangle may not see intermediate wave D complete. It could be more time consuming. We could have A, B, C. It could be a more obvious 3-wave zigzag at the weekly chart level. It could move higher, and it can't move beyond the end of B above 1357.09 if X is a regular contracting triangle. X could also be a regular barrier triangle, which means D could end about the same level as B at 1357.09, and in practice means D can end very slightly above the end of B. As long as the BD trend line remains essentially flat, a triangle for this wave count will remain valid. Unfortunately, that is the only Elliott Wave rule which is not black and white. It involves a subjective grey area, and so that's why for the bullish wave count we need to see movement reasonably above this point in order to have a lot of confidence in it. Let's take a look at the classic analysis. This week we've got a red candlestick. It's a spinning top, it's got a small real body and a reasonably even long upper and lower wick. That represents indecision, a balance between bulls and bears. It looks like the upward trend at this stage is somewhat stalling. The balance of volume this week was down, and we saw a decline in volume. So the downward movement within this week saw the market essentially fall of its own weight. So that's slightly bullish. We don't need volume to support downward movement for it to be continued for some time. The market can fall of its own weight because price can fall due to an absence of buyers in the same way it can due to increasing activity from sellers. It looks like price is hitting resistance about 1345. Down below, if we see more downward movement, there's still that strong area of support about 1305 to 1310. On balance, volume offered us a bullish signal here. It's moved lower. If it comes down lower, we'll expect support at this purple trend line. ADX is still below 15. It's too low to tell us that at this stage, at the weekly time frame, that there is a new trend, and the positive and negative DX lines have been whipsawing about each other. Price is still essentially range bound with resistance about and just above 1345 and support, final support, around about just above 1220. ATR has been declining for many months now, and this still strongly supports a triangle, an Elliott Wave triangle at the weekly chart level. So that would support the first and third weekly charts. RSI is neutral, plenty of room for price to rise or fall, and stochastics is overbought, but just because it's moved fully into overbought territory does not mean upward movement has to end here. When it moved fully into overbought territory here, that was not the end of upward movement. It still continued quite substantially for another couple of weeks or so. That could certainly happen again. What about the shorter term picture at the daily chart level? Things are still looking full bore bullish. The short term average is above the mid term, is above the long term, and price is above all three, and they all have positive slopes. This is a full bore bullish look. The problem, though, of course, with moving averages is they are lagging indicators because they're based on averages. But the situation at hand with the information we have today, this chart is very bullish. This trend is stretched and it's extreme, but at this stage there's not enough weakness to indicate that it could be over. We could have a blow-off top on this doji here, an upward day with a strong increase in volume, and the volume increase is strong enough for a blow-off top to be indicated. Blow-off tops aren't always the end of the movement though. After them, often you see a bit of a consolidation and then some more upward movement, and it looks like that's what could be about to happen. These three candlesticks here, two doji, and now an upward day with a long upper wick, all look like we could be seeing a consolidation within a larger upward trend because it's coming on light and declining volume. That volume profile is really normal for a consolidation and not necessarily the start of a new trend. For the very short term though, the long upper wick on this candlestick looks bearish, so I'd be expecting a red candlestick for Monday to follow that as very likely. On balance, volume is very bullish. RSI was overbought, but it does not exhibit weakness with price. If we get another upward thrust and RSI moves into overbought, if we then see some strong weakness, then I would be looking for a high in place. The upward trend is now very extreme because the ADX line is above both directional lines and it's above 35, so that's moved into very extreme territory. So I would be expecting an end to this upward trend here or quite soon, but it's not particularly a good timing tool. This can extend and remain very extreme for a while longer, and price can move up substantially further before it turns. We do have some reasonable divergence between price and stochastics though, so that looks a little bit more bearish than price and RSI. Bollinger Band starting to contract. Now that can happen either during a consolidation or at the start of a new trend, and it's impossible to tell which of those situations is occurring from contracting Bollinger Bands. And MACD still fully bullish. And we had another comment from one member in comments about gold and the S&P 500, making an assumption that they're correlated. I just want to draw members' attention to this one again. This is why I leave it at the bottom of gold charts every day. The correlation coefficient between gold and the S&P is totally and utterly unreliable. It swings from positive to negative through to positive, and any correlation coefficient that spends time in the shaded area between 0.5 and negative 0.5, is completely unreliable. So don't assume that because I expect analysis of one market is to do something, that then my analysis of the other market must say it has to do anything else related to it, because the math shows us those assumptions are just not valid. Assume the trend remains the same until proven otherwise. That seems like a pretty safe assumption with this strong bull market. Assume the upward trend is intact and corrections are an opportunity to join the trend. If we follow that assumption, we'll be right every time until the final time, when it moves into a bigger, longer lasting, deeper correction. The next target for an interruption to the trend is at 2821, but it's only an expectation of a maybe 1 or 2 week interruption. Could be a bit longer, but at this stage let's assume that it's just going to be a smaller fourth wave correction along the way up. I've got an alternate that looks at a correctional pullback that could have already be underway to last 1 to 2 weeks. We can have some confidence in that view if price can make a new low below 2792.56. And that view does have support from bearish signals in VIX and the AD line, but those recent signals have either failed or they're early signals at this stage. So let's look at the monthly chart first, have a quick look at the bigger picture. At the end of the global financial crisis, I'm seeing that as the end of a super cycle fourth wave. And so that's where a fourth wave ends and a fifth wave begins. And I'm seeing this fifth wave at super cycle degree within a grand super cycle first wave. And so when this whole structure is complete, I'll be expecting a huge trend change at grand super cycle degree, but we're absolutely not there yet. I expect that trend change is at least 1 year away and maybe even 2 or 3 years away. This supercycle fifth wave is unfolding as an impulse. There are only 2 structural possibilities it can take, an impulse or an ending diagonal. At this stage, it's pretty obviously not an ending diagonal, it's an impulse. The impulse subdivides so far with cycle 1, 2 a zigzag, 3 an impulse with no adequate Fibonacci ratio to 1, 4 a more time-consuming combination, and the fifth wave at cycle degree begins here. Because there's no ratio between cycle waves 1 and 3, it would be more likely that cycle 5 should exhibit a Fibonacci ratio to either 1 or 3. It was most likely to exhibit equality in length with the first wave, but it's past that, and so the next Fibonacci ratio in the sequence is used to calculate the next target at 2926. If price gets up to this first target and the structure is incomplete, or price just keeps on going up, then we'll use the next Fibonacci ratio in the sequence, and so on. At this stage, at the monthly chart level, there's no divergence between price and RSI to indicate weakness. I would expect that to develop before we see a final high in place. Let's look now at the weekly chart. From this major low down here, I am expecting that was a trend change at cycle degree and the end of a fourth wave within a larger impulse, and here the fifth wave is incomplete. When this fifth wave, labelled cycle wave 5, is complete, it should look like an obvious 5-wave structure at the weekly chart level. In order for a wave count to look like an obvious 5, its second and fourth wave corrections have to be reasonably in proportion to each other. It's the proportion between those counterpart corrections which give an impulse the right look. And so I'm expecting along the way up a couple of big corrections, the first one coming up for intermediate 4, and after that another big one, maybe even a bit bigger, for primary wave 4, and then final fifth waves up to new all-time highs after those big corrections. And so this whole structure to complete is probably going to take another 1, 2 or 3 years to complete. Primary wave 2 here lasted 10 weeks, and I think intermediate wave 2 lasted 11 weeks. So they're about nearly 3 months in duration each. And so if we see about 3 months in duration for intermediate 4 and primary wave 4, that's 6 months just for corrections, and then we've also got fifth waves following them to move on up to the new highs. So the whole thing certainly could easily take well over a year to complete. 1 year is probably the earliest. We also need to see a bare minimum of 4 months divergence between price and the AD line start to develop before I'll be ready to call an end to cycle wave 5. So I think the high is still quite a long way away. Cycle wave 5 has passed equality in length with cycle 1. That would have been the most common Fibonacci ratio for it to exhibit. That was about the round number pivot of 2,500. It got up there, but the structure was incomplete and price just kept on going higher. So the next target to calculate uses the next Fibonacci ratio in the sequence, 1.618. That would be achieved at 2926. Now it's still possible that could be the right target about that point. No, if we have time-consuming and deep fourth waves, and fifth waves that don't make substantial highs beyond the end of the third waves, this target could entirely be right. But if we get up there, and again the structure is incomplete, or if price just keeps on going up through that target, then we should use the next Fibonacci ratio in the sequence, 2.618 to cycle wave 1. That'll be achieved about 3616. And again, if we get up to that point and the structure is incomplete or it just keeps on going up, then we will have to use the next Fibonacci ratio in the sequence. But once we get beyond 2.618, then we start to look for ratios between the fifth wave and the third wave. So then I'd be looking for equality with the third, or 1.618, the length of the third. This fifth wave is drawing out to be a long extension. Cycle wave 1 was not extended, cycle wave 3 was extended, so it would have been most likely that cycle 5 was equal with 1 and not extended, but you can still have two extended actionary waves within an impulse. So cycle wave 5 is extending, and that still fits quite nicely Elliott Wave rules. Within intermediate wave 3, it may only subdivide as an impulse. We have 1, 2 lasted 4 weeks, 3 is incomplete. When 4 arrives, I'll expect it to last about a 4, maybe a Fibonacci 5 or 8 weeks, and then we'll have 5. Intermediate wave 3, when it's complete, should look like a fairly obvious 5-wave impulse at the weekly chart level. And when minor wave 4 within it turns up, it can't move into wave 1 price territory below 2400.98. Let's take a look at the daily chart now, where we're going to see the middle of intermediate 3, where minute 1 and 2 is this high and low. Minute 2 lasted just a couple of weeks. It was a shallow zigzag. So when minute 4 turns up, let's expect it to be a flat combinational triangle and maybe last about a couple of weeks as well. As price makes new all-time highs, keep redrawing the acceleration channel from 1 to the last all-time high. Place a parallel copy on the end of 2. When 3 is complete, that would then be an Elliott channel, and the lower edge should provide support for a fourth wave if it were to be that deep, but it could also be about the midline of that channel. Minute wave 3 has passed 1.618, the length of 1, so we use the next Fibonacci ratio in the sequence to calculate the target, 2.618. Minute wave 3 may only subdivide as an impulse. So far, I expect we have a long extended first wave, a shallow combination for a second wave. The target calculation, is calculated at the hourly chart level, and it expects the third wave may be shorter than the first wave. That's okay, it doesn't have to be longer, and this first wave looks like it was a very long extension. And so the target for minuet 3, calculated at the hourly chart level, is at 2821. Minuet 4, when it arrives, may not move into wave 1 price territory below 2694.97. I'm going to see minuet wave 3 over here, and now minuet wave 4 unfolding as an expanded flat, subdividing 335. Although expanded flats are really common structures, the last few times I've considered this possibility, it's always turned out to be not true. And so I'm a little bit hesitant about this wave count at this stage, and although the trend is extreme and stretched for the S&P at this stage, we don't have enough weakness to indicate a multi-week correction beginning here. Doesn't mean it can't happen, it just means it doesn't have a lot of support today from classic technical analysis. If we do see the main wave count invalidated at the hourly chart level, I'll consider this alternate. I'll expect that then we could be in a correction to last a couple of weeks so that it's in reasonable proportion to its counterpart second wave. If it gets down that low, look for it to find support at the lower edge of the Elliott channel. Minute 4 may not move into wave 1 price territory below 2490.87. Let's look at classic analysis now and see how much support for the main wave count there is. This week is another very bullish week. We've got a long lower wick, that's bullish. New all-time highs, a small real body, that's okay. Now this could be a hanging man, but the bullish implication of the long lower wick from a hanging man absolutely requires, the bullishness of the lower wick requires bearish confirmation in the next candlestick before you can have any confidence that you've got a hanging man in place. So I'm not going to label that as a hanging man at this stage. It could be, but we need bearish confirmation. Essentially, hanging mans really are two candlestick pattern reversal patterns because of that confirmation requirement. This week we've got an upward week, on slightly declining volume. That's slightly bearish, but that certainly doesn't mean upward movement has to end here. That's happened before, and yet price just continues on upward. We will have an interruption to the trend, but the slight decline in volume this week, that's not an indicator that it has to happen here. On balance, volume remains very bullish, and there's no sideways range yet to show us, to give us support and resistance lines to look for a breakout. It's just very bullish indeed, supporting the upward trend. RSI is extreme. It could certainly get more extreme, and it can remain extreme for quite a long time before price is ready to turn. What we want to see is RSI extreme for some time, which it has been now, and then develop clear and strong divergence with price before we assume that we're going to have a bigger interruption to the trend. That is not the case yet. The trend is still up, and it can remain extreme for quite a lot longer. It's been extreme for many weeks. It could continue for longer. ADX also is very, very extreme. It's above 35 and above both directional lines. There will be an interruption to the trend, but this can remain extreme for many weeks before we should expect a trend change or a big consolidation, and MACD is very bullish. The trend is stretched and extreme, but because there's no divergence between price and RSI at the weekly chart level, don't expect a big interruption yet at this stage. It could happen, but the indicators say it's more likely it won't happen at this stage. Balance of probabilities. What about the short-term picture? There's a little bit more of weakness here, but it's only between price and stochastics. An upward day for Friday, a new high, a higher low, a green candlestick, and some support from volume. That's bullish. We've got some divergence between price with the new high for Friday and RSI, but it's quite weak, and stochastics, but it's also quite weak. So there is divergence, but I really would want it to be clearer and stronger divergence before I expected we're going to get a good interruption to the trend. Let's wait and see if that's going to develop. Until that exists, let's assume the trend remains the same. On balance, volume hopefully is going to give us a signal on Monday. I was expecting it on Friday, but it just didn't move enough. We've got a little resistance line and a little support line. The support line tested 3 times, the resistance line only tested twice before. So the signal's going to be weak, but it will be a signal nonetheless. If we get a break above resistance on Monday, that'll be a bullish signal, that'll support upward movement, assume the trend remains the same. MACD fully bullish, and Bollinger Bands very nicely expanding along with this upward movement, and price can remain around the upper edge of Bollinger Bands for quite a long time. Just because it's at the upper edge of Bollinger Bands does not mean it has to turn. It's actually just below the upper edge of Bollinger Bands for Friday, so plenty of room still for price to continue on upward. What about these signals, though, given by VIX and the AD line? We've now got 5 bearish signals in the row from VIX and price with bearish divergence. Price is moving higher, but it's not coming with a normal corresponding decline in market volatility. Market volatility was increasing. Remember, this is inverted VIX. Market volatility did decline quite strongly with Friday's upward movement, but not enough to be a normal corresponding decline. Price has made a new all-time high, but volatility hasn't made a new all-time low. So there's weakness within price. That's how we read that. That's bearish divergence. So far, however, the signals given from inverted VIX diverging with price has not led to any real downward movement from price. Price just keeps on going up. We've had a couple of red candlesticks, but we've had new all-time highs. This could be a warning of something a little bit bigger to come. It could be an early warning sign, or it could simply have failed. We don't know yet. A couple of bearish signals from price in the AD line. We've got a new all-time high for price on Thursday, but the AD line has failed to make a corresponding all-time high. The rise in price for Friday did not have support from a similar rise in market breadth, so that's bearish. But again, recent bearish signals between price and the AD line have not led to any real downward movement. They've just simply failed. Again, this could be early warning signs beginning to develop of some bigger correction about to come, which you would expect with a trend this extreme and stretched, but not quite here yet. And now into the US oil analysis. The bottom line for oil is that while price remains within the yellow channel on the daily chart, although it looks like we have a high in place and a possible trend change, we don't have confirmation of that, and so we can't have confidence at this stage in that wave count. It does have support from classic analysis though. If price breaks below the lower edge of the channel, then we can have confidence the high is in place and the target is at 24.67. Let's take a look at the bigger picture for oil, a monthly chart, where a super cycle first wave is expected to have ended here, and a super cycle second wave correction begins, unfolding as a zigzag subdivide 5, 3, 5. I expect it's incomplete down here, subdividing as an impulse for cycle wave C, 1, 2, 3 is a nice impulse, 4, and now 5 may have begun. It looks like upward movement is finding resistance at this trend line, which previously provided resistance, was broken through and then provided support, and now price is below it again. And so in the first instance at least, I would expect this trend line here to provide resistance. I've drawn this trend channel using Elliott's technique around a zigzag from the start of A to the end of B with a parallel copy on the end of A. It doesn't perfectly show us where price found resistance, but it mostly does, and so I would expect it should work again if this wave count is correct. If primary wave 4 does continue any further, then it may not move into wave 1 price territory above 74.96. At this stage, primary 2 was a deep single zigzag, and here primary 4 is a more shallow single zigzag. So there's some alternation within them, but not the best alternation. Alternation is a guideline and not a rule. Let's take a look at the weekly chart level, where the low for primary 3 is this point down here. So primary 4 subdivides so far 5, 3, 5. I know that's a bit odd to call a 5-wave triangle a 3, but it's classified as a 3. 3s in Elliott Wave are corrective structures, and a triangle is a corrective structure. So intermediate wave A is a 5-wave impulse, intermediate wave B is a running contracting triangle, and intermediate wave C now looks like it's complete, and we have a red weekly candlestick closing for this week. It looks like we might have a high in place very, very close to the upper edge of that trend channel I showed you in the monthly chart. If this is the case, then the appropriate Fibonacci ratio to use to calculate a target for primary 5 is equality in length with primary 1. That would be achieved at 24.67, which would see primary 5 move a little below the end of 3 and avoid a truncation. The weekly chart level, if we can see a full weekly candlestick below the lower edge of this Elliott channel, we can have a lot of confidence in this wave count. Let's look at it at the daily chart level, where intermediate C begins here, this point down here. Intermediate wave C may only subdivide as a 5-wave impulse. It may have subdivided 1, 2, 3, 4, 5. I was waiting for the final 5th wave to look like it was complete, and if it's complete at this last high, then we have some good Fibonacci ratios. The whole structure at all degrees is complete, and it has a really good look at the daily chart level. We've got 3 days of downward movement, but the bottom line for oil, like I said for the summary, is while price remains within this yellow channel, we do not have channel confirmation of a trend change, and the wisest approach to this analysis and this market at this time is to assume that the trend remains the same until proven otherwise. We need to assume that the trend remains up until we have a full daily candlestick below this trend line and not touching it. And then we can have confidence in this trend change and confidence in the target. The upward trend is stretched and extreme. We will have at least a deep pullback, if not a trend change, either here or coming up very soon. Let's look at the classic analysis, and let's make that a little bit bigger. And bigger again, that's better. At the monthly chart level, there are 3 advancing white soldiers, 1, 2, 3 at the monthly chart level. We've got another 2 months of upward movement following that, and we have price rising on declining volume. 3 advancing white soldiers is a bullish continuation pattern, but it makes absolutely no comment on how long or how far a bullish trend should continue. It could have ended here. That's entirely possible. For price to have a sustainable rise, it should have support from volume. It needs the activity of buyers in order to consistently and sustainably push up price. That's not the case here. We've got overall, for a few months in a row, pretty much this whole rise in price is now coming on a decline in volume, and so it should be quite suspicious. RSI is not overbought. There is room for price to rise further. MACD remains bullish, and on-balance volume remains bullish. What about the daily chart level for the shorter-term picture for US oil? The moving average picture is full bore bullish. The short is above the mid, is above the long-term 200-day moving average, and price is above all three, and all of the averages have positive slopes. That's a full bore bullish look. We have, however, a high possibly in place with a blow-off top, and now the last 3 days of downward movement comes on increasing volume. So while at the monthly chart level this rise in price has declining volume, for the short term we now have falling price on increasing volume. That adds a little bit more support to the idea that we might have a high in place up here. ADX reached extreme, very extreme for that upward trend. It was above 35 and it was above both directional lines. That's very extreme. And now for Friday, it's turning lower, indicating that the upward extreme trend might have ended. ATR was showing some increase after some reasonable period of decline. On balance volume is still very bullish. This resistance line is very weak. RSI reached overbought and might now be returning down into neutral territory, and stochastics reached overbought and there exhibited divergence with price to indicate some weakness. And so with RSI overbought at the high and stochastics overbought at the high and ADX very extreme indeed and stochastics exhibiting divergence, that all offers support to the idea that we may have a high in place. That's why I say the technical analysis this week for oil does support the wave count, but the bottom line still is we really need to see that trend channel on my daily Elliott Wave chart breached before we can really have confidence that we have a high in place. For the very short term, there is some bullish divergence between price and volatility for US oil. Price for Friday made a lower low and a lower high, the definition of downward movement, but it hasn't come with a normal corresponding increase in volatility. Volatility has declined, and so this downward movement for Friday comes with divergence with volatility. That indicates there may be some weakness within price. However, I would give more weight to that last classic analysis chart than I would to any divergence between price and volatility, because the correlation coefficient absolutely shows that there is no reliable relationship between these two sets of data. It's assumed that there should be a negative correlation, but this absolutely shows that the maths shows that is absolutely not the case. So this is a weak indicator. I do not give it much weight. That's all for me with your new end of the week analysis, and I hope that all of our viewers and members are having a fabulous weekend.